So if you see from a gold market perspective, what's really helping gold market currently is largely the geopolitics that is playing out. If you see the Middle East crisis that we have, the war between Israel and Lebanon, and now Iran being dragged into it, that's kind of helping gold markets. Uh, had it not been for the geopolitical tensions that we are seeing, gold would probably be lower than what it is today. So it's very difficult to say how Putin will think or how Iran will think or how Israel will think. But things don't look very good from a geopolitical standpoint. So from that perspective, this will continue to support gold markets because every country wants to diversify away the risk that they are seeing. Because this is a very real risk, right? We don't know how it's going to pan out. Is it going to be over in like 5 minutes because of nuclear possessions that these countries have? Or is going to be a long drawn affair over a few months, few years kind of thing? Like Russia-Ukraine crisis that we saw, it erupted in 2022 and we thought it will be over, right? But it's still ongoing. If you see, there has been an impact of lagged effects of monetary tightening. If you see, interest rates in the US went from 0 level to 5% in 1 year's time. If you had asked anyone that interest rates are zero today, if it were to become 5% in next 1 year, what would happen? People would say that equity markets would collapse, gold will collapse, a doomsday kind of scenario. But it didn't happen that way because there was so much money being pumped in before that, which led to that inflation and which led to that interest rate increase, that asset markets were still doing well because of the so much liquidity being around. So the bond yield curve in the US was telling us, when this yield curve is negative, it tells us that there is a problem in the economy, and probably this has been a leading indicator of recession to come in the economy few years or a few months down the line. So we are seeing that this has been negative for quite some time now. Also, if you see, inflation has been coming down, but if you see over last few months, it's been very steady at this level. It's kind of grinding down rather than falling down now. And this means that, given the effects of monetary tightening that they did for last 1 year, the effects of that has started to show up in the economy. It's always a lagged effect. And now we are seeing that effect come in the economy, and it's impacting growth. And that is why we saw Fed cut rates by 50 basis points. Everyone was expecting 25, they did 50, right? And therefore, they have two issues at hand. One is probably impact on growth over a period of time. If you see unemployment rate, it's still low by historical standards, but started to move up. And when that happens, it worries Fed. And second is that debt across the economy, especially at the central government level, is so high. They have to pay very interest payment, pay close to 800, $900 billion in interest payment alone, which leads to impacting the fiscal deficit of the US. And hence, it also is an imperative why Fed is cutting rates. So we will see more rate cuts in the US going forward. Probably markets are very aggressively pricing those cuts, and it may not happen in that fast manner. Unless and until growth collapses significantly, rate cuts will be gradual from here on. And if that were to true, irrespective of if geopolitical tensions were to subside to some extent, probably gold may correct a bit in the interim. And second impact that gold usually has apart from interest rates is how is the dollar behaving. If dollar goes up, gold falls. If dollar goes down, gold moves up. So if you see, this is very clear, right? The orange line is gold and the blue line is the dollar. So as you see, dollar started falling, gold started moving up. So we think that dollar will be on a weaker ground going forward because they have very high deficits, very high debt, and a slowing economy. If that happens, will have impact on stock market or asset prices in the US, and therefore dollar will weaken. If you see total debt, this is what I was referring to. Total debt has been moving up. It's close to around 130% of GDP today in the US, which is sort of unsustainable. And US dollar has been declining or weakening because of that high debt. Uh, Also, what we are seeing is, if you see, this is the rising deficits that we see. See, since such a large number of years, the US has been running deficits year on year, right? Even at this point in time when economy is doing well, they are still having deficits. If economy were to fall down, what we have seen is each time there is an impact on the economy, they tend to aggressively cut rates, pumping a lot of money in the economy. And that is, if there was a meaningful correction or an impact on the economy, you will see that they will again intervene with the same things. So interest rates will go down, and they will print a lot of money to put in the economy. So this is total debt to GDP ratio, which, as I said, close to 130%. So this, because of this unsustainable dynamics of the US government, people are losing confidence in the dollar. Today, dollar is valuable to some extent because there is no other alternative. And that is why central banks across the world have been buying a lot of gold. One is because they learned from the US, Russia-Ukraine situation that Russian assets US froze overnight. So that tends to tells people that if we have anything incorrect going on with the US, they could impact us in a very adverse manner. So we need to diversify. And that is why you see many central banks, including Indian Central Bank, RBI, has been buying a lot of gold. And if you see the survey of many central banks, they say that they will increase their gold allocation over next 12 months. So last 2 years, 22, 23, they bought more than 1,000 tons of gold. And even this year, they have already been closer to about 500 tons in the first half. So central banks have been buying gold in significant quantities. And the biggest test, we think gold is a monetary asset, and it moves because it has history of being used as a currency or backing a currency. And today, even central banks have part of their reserves in gold, which makes it a monetary asset in some sense. And if you see this graph, whenever US money supply on up, gold tends to move up because it is the counter to the debasement of the dollar. So if you see, still there is gap in terms of it will catch up over a period of time if it were a true monetary asset. And usually when it goes above this line, usually it's a mark that you should caution in terms of, fundamentally whether gold prices will keep going up or not. But if this orange line keeps moving up, probably there is room that will come for gold prices to appreciate. This is what I was talking about, that people are losing confidence in the dollar. The share of dollars in other central banks' reserves is declining. What was about 72, 73% at the peak, it's now come down to about 58%. So people are certainly moving out of dollar into other things plus gold. And this is the comparison of various bull markets that we have seen in gold. If you see 1971 to 74, look at the price increase that we saw, about 400%. If you see 76 to 80, it rose again close to 400%. The 2000 to 2012 was a big bull market in gold that we saw. At that, it increased by about 500%. In this bull market that started in 2015, end of 2015, is just about 100%. So people say that gold is at peak levels. We have looked at in comparison to previous markets that we have seen in gold. And if gold were to go to, so people say, what will reach gold of 1 lakh first, right? Whether it will be gold or Sensex. And if you see that at different gold price levels and different rupee rates based on current duty, which is 6%, this is the gold price that you will get. So if gold prices were to move to about $3,500, they are at $2,700 today, and rupees around 84. So if it were to reach 3,500 rupees staying the same, it will be about 1,01,000 rupees, which is about 20% increase in gold price from current levels. So you need to see these are the two things that move gold prices. One is the rupee rate and one is the international gold prices. So we are price takers whenever there is no India price. Whatever international prices multiplied by the rupee rate, add duties and taxes, you come at the Indian gold price.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.